We lost the dollar as the world currency. It's like Russia. It's going out now and doing its own thing. And, they're going out bragging about how they don't need us anymore. We cannot lose our dollar standard.
And it's a ticking time bomb. And according to the IMF, it is ticking louder than ever.
The US dollar just recorded its worst first-half performance in 50 years. Global stocks are shifting. Crypto is bouncing back. And Canada? They've just scrapped a tech tax that could have shaken US trade. What's happening across Asia, Europe, and North America right now is setting the tone for the global economy. The dollar's deepest slide. Since 1973, it's official. The US dollar index has dropped 10.5% in the first 6 months of this year, landing at 96.80. That marks the dollar's steepest first-half decline since 1973. Back when the US first moved off the gold standard and shifted to a free-floating exchange rate. The fall is linked to multiple factors, but one of the biggest is the shift in expectations around interest rates. With Federal Reserve Chair Jerome Powell preparing to exit and market speculation growing over future rate cuts, investors have been backing away from the greenback. And it's not just whispers anymore. There's a broader sense that the Fed will pivot to easing policy sometime in 2025. Even as the economy stays strong, traders aren't waiting around. They're already rotating toward assets with better yield prospects, especially with signs of tightening in Japan and potential action in Europe. Against the Japanese yen, the dollar dropped to 143.97 yen, while the euro surged to $1.1783. Sterling ticked up as well, now trading at $1.3725. Trump's tariff threats shake global confidence. Another pressure point weighing on the dollar is uncertainty from Washington. U.S. President Donald Trump's return to aggressive trade policy is causing international concern. On April 2nd, he announced sweeping tariff hikes ranging from 11% to 50%, affecting dozens of countries. A temporary pause was granted until July 9th, but Trump has made it clear, countries that don't negotiate in good faith won't get extensions. Treasury Secretary Scott Bessent reinforced that stance in a Bloomberg interview, saying the decision for any delay will rest solely with the president. If no deal is reached, the U.S. will revert to the high April tariff levels. The message is unmistakable: compromise or face higher costs. Canada backs down on tech tax. One major policy reversal happened just in time. Canada had planned to start collecting a new 3% digital services tax on U.S. tech companies' firms like Amazon, Meta, Apple, and Google starting Monday. The law would have applied to annual digital revenues over $20 million and retroactively taxed activity back to 2022. But under pressure, Prime Minister Mark Carney pulled the plug. Just hours before collection was due to begin, Canada's finance ministry announced that the tax would be scrapped. Carney personally called Trump to share the news, prompting a fast response from the White House. Caroline Leavitt, Trump's press secretary, called it a big win for U.S. innovation and claimed Carney caved to Trump's demands. Commerce Secretary Howard Lutnick echoed that view, thanking Canada for stepping back from what he called a deal breaker. Finance Minister François-Philippe Champagne confirmed that legislation will now be introduced to formally repeal the Digital Services Tax Act. This opens the door to resume trade talks between the two countries, with a new deadline set for July 21st. Political repercussions for Canada. Domestically, Carney's move is getting mixed reactions. The Canadian Chamber of Commerce welcomed it, arguing the tax would have raised prices and hurt consumers. Vice President David Pearce said the decision was the right one at a critical time, but political opponents aren't as forgiving. Opposition leader Pierre Poilievre accused Carney of breaking campaign promises, saying the Liberal Party had pledged in April to stand up to Trump. Canadians need certainty that Liberals will put Canada first and defend Canadian sovereignty, Poilievre posted on X. Others question the speed of Canada's reversal. Vas Bednar from the Canadian Shield Institute remarked, "It feels like we're standing down really quickly. For a government that campaigned on economic strength and independence, the optics aren't great, but the stakes are high. Canada is the United States' second-largest trading partner, trailing only Mexico. Last year, it exported $412.7 billion to the U.S., while importing $349.4 billion. A breakdown in negotiations could hit both economies hard. especially with existing tariffs already in place on Canadian steel and aluminum at a steep 50%. Stock markets surge on renewed optimism. With Canada stepping back from the tax and resuming trade talks, Wall Street responded quickly. On Monday, the 30th of June, all three major U.S. indexes reached new records. The Dow jumped 275.50 points to close at 44,094.77. The S&P 500 added 31.88 points to hit 6,204.95. And the Nasdaq gained 96.28 points, finishing the day at 20,369.73. Tech stocks led the rally, fueled by relief that the digital tax battle may be over for now. It's a signal that, despite all the noise, investors still have confidence in the system's ability to correct course before real damage is done. Asia's trade currencies hold breath as U.S. deadlines approach. Across Asia, things felt paused. Currency traders weren't moving much, and that's saying something in a region that usually reacts fast. Most Asian currencies moved little on Thursday, July 3rd, as investors watched carefully for signs of progress in global trade talks. Washington's July 9th tariff deadline is looming, and for many Asian economies, it's not just a headline, it's a countdown. Countries like Vietnam and India are still deep in negotiations with the US to avoid being hit with Trump's Liberation Day tariffs. A deal with Vietnam has already been signed, but for countries with bigger economies like Japan and India, the road to a signed agreement looks tougher. In the meantime, the markets are on edge. Any deal could shift export flows, disrupt supply chains, or open up new trade routes entirely. And with the US now reviewing tariff rates across dozens of countries, traders are keeping their currencies close to the chest. Weak data from China and Australia spook regional confidence. Adding to the caution was a fresh round of weak economic data. In China, a closely watched PMI number for the services sector showed slower than expected growth in June. Technically, the reading was still positive. It marked the 30th straight month of expansion, but the soft pace raised some eyebrows. That same day, Australia posted disappointing trade data. Maize exports dropped more than forecast, which pushed the Australian dollar down by 0.2%. For a country that relies heavily on shipping minerals and resources, a dip in trade figures hits hard and fast. The Australian dollar wasn't alone. The Taiwan dollar also slid, falling 0.3% after renewed concerns about U.S. chip export controls, which directly impact Taiwan's massive semiconductor industry. China's yuan steady despite tech tensions easing. Over in China, the yuan stayed flat, even as news came in that Washington had quietly eased some export restrictions on chip design software. Several major chip design firms confirmed that the Biden administration had relaxed specific rules that previously blocked sales to Chinese firms. While this was seen as a modest improvement in US-China trade relations, the Chinese currency barely reacted. The market, it seems, is waiting for deeper, more structural breakthroughs. For now, it's more of a symbolic win than an economic one. The Taiwan dollar drops as chip makers brace. Unlike China's currency, Taiwan's dollar didn't hold. It fell 0.3% on Thursday, July 3rd, making it one of the worst performers in the region for the day. That's because even with relaxed restrictions on China, US policies are still targeting specific tech sectors, and many of those are based in Taiwan. With companies like TSMC already under scrutiny and Washington pressing for more chip production to move to the US, Taiwan's semiconductor hub feels vulnerable. Investors took note, and the currency dipped as a result. US dollar recovers slightly, but pressure remains. The dollar made a small comeback in Asian trading, with the dollar index rising 0.1%, but that's after touching a 3-year low earlier in the week. And even now, the greenback is facing heavy resistance. One of the biggest things weighing it down? Uncertainty around the US economy. The House of Representatives is set to vote on a sweeping tax and spending bill, which many see as the financial centerpiece of Trump's re-election campaign. But the bill also raises concerns. Economists and credit agencies alike are worried about what the spending could do to America's already high debt levels. Payroll numbers and rate cuts. There's also another big test coming later today, June's non-farm payrolls report. This jobs data release could heavily influence what the Federal Reserve decides to do next on interest rates. For now, expectations are growing that the Fed could cut rates sooner than expected, possibly before fall. Fed Chair Jerome Powell is under renewed pressure. Trump has openly attacked him again this week, saying that rates are too high and claiming that Powell is standing in the way of stronger American growth. But not everyone at the Fed is convinced. Raphael Bostic, president of the Atlanta Fed, said the economy still hasn't felt the full impact of Trump's tariffs. He warned that inflation and unemployment could rise at the same time, a potential recipe for stagflation. Still, others like Austin Goolsbee of the Chicago Fed remain optimistic, saying there's no hard evidence of stagflation yet, though the risk is clearly rising. Global debt risks and U.S. fiscal stability on edge. As Congress debates the tax bill, the Congressional Budget Office dropped a sobering estimate. The new plan could add $3.3 trillion to the U.S. debt over the next decade. That's a big number, and it's starting to scare global bondholders. Foreign appetite for U.S. treasuries has already been shaky, and now the concern is that long-term buyers, especially from Asia and Europe, might start pulling back. If that happens, the dollar's decline could accelerate, and interest rates could spike even before the Fed acts. Indian rupee and Japanese yen stay calm for now. Other major Asian currencies were surprisingly calm. The Indian rupee barely moved, despite India's ongoing back and forth with U.S. trade representatives. While talks are ongoing, a final agreement still seems far away. The Japanese yen, meanwhile, ticked up just 0.1%, with Tokyo officials hoping to avoid triggering any fresh disputes with Washington. That calm may not last. If the U.S. imposes new tariffs, or if the Fed surprises the market with an emergency rate cut, both currencies could swing quickly. Singapore, South Korea, also on traders' radar. In Southeast Asia, Singapore's dollar edged slightly higher, while the South Korean won rose 0.3%. Both countries are watching U.S. trade talks closely, especially since they rely so heavily on exporting high-tech goods to American markets. For South Korea, the added concern is North Korea. While geopolitical tensions haven't flared this week, any shift in the regional balance or a sudden policy move from Pyongyang could change that in an instant. Crypto finds a second wind. As the dollar continues to slide, digital currencies are quietly climbing. Bitcoin has pushed past $44,000 again, with Ethereum following above $2,900. Some of this is seasonal, some is technical, but part of it is tied to the broader macro environment. When the dollar weakens and real yields fall, alternative assets start to look a lot more attractive. There's a growing view that crypto may find favor again among investors who want to hedge against dollar weakness, future inflation, or even geopolitical risk. Unlike past rallies, though, the tone is more measured. There's less hype and more strategy. Europe races against the clock. While Asia watches from the sidelines, Europe is charging headfirst into deadline diplomacy. The European Union is under major pressure to seal a trade deal with the US before July 9th, the day new tariffs could slam into nearly every EU export. We're talking potential jumps of up to 50% on goods headed to American consumers. EU Trade Chief Maros Sefcovic is in Washington on July 3rd, sitting down with U.S. Commerce Secretary Howard Lutnick and Trade Representative Jamieson Greer. The goal? Strike at least an interim deal, something that allows both sides to keep talking past the deadline without facing immediate damage. And while the EU appears open to a 10% universal tariff on exports as part of a compromise, they're also preparing to retaliate if no progress is made. Brussels doesn't want a trade war, but they won't walk into one empty-handed either. Von der Leyen under fire. Even as the EU negotiates trade terms abroad, trouble is brewing at home. European Commission President Ursula von der Leyen is facing a no-confidence vote next Thursday. The controversy? Her handling of private text messages with Pfizer CEO Albert Bourla during vaccine negotiations in the pandemic. Though the motion has enough signatures to be debated, she's expected to survive the vote. But it's another sign of growing tension within EU politics as Brussels balances global influence with domestic credibility. The climate commitment versus reality. On Wednesday, July 2nd, the EU unveiled a bold proposal. Cut emissions by 90% by 2040. That's a massive step toward the EU's pledge to reach climate neutrality by mid-century. The draft includes some built-in flexibilities for countries struggling to meet targets, but debate is already heating up. Member states are split not on whether to act, but on how far and how fast. Meanwhile, Europe is facing record-breaking heat linked to Saharan air masses and unusually warm seas. The heat is already damaging infrastructure, stressing power grids, and threatening nuclear energy output in France and Germany. This heat wave isn't just environmental, it's economic. Higher energy costs are squeezing businesses. And the push for green transformation now comes with an even sharper urgency. Currency jitters. There's a new worry among ECB officials. The euro might be getting too strong. It's now on the verge of its longest winning streak against the dollar in over 20 years. Sounds great for consumers, but it's starting to hurt Europe's exporters. A strong euro makes EU goods more expensive on the global market. And with inflation still above target, policymakers are trying to avoid overcorrecting. The ECB wants stability, but currency momentum is harder to tame than interest rates. Pension shakeup. In the Netherlands, a massive shift is coming. Over 11 million Dutch citizens will soon move to a new retirement system, impacting $1.9 trillion in assets. This change will push pension funds into riskier assets, and analysts are warning of possible bond market volatility across Europe. With such a large-scale reallocation, even small moves could shake government bond yields and liquidity. It's another reminder that the private retirement sector is now closely tied to broader macroeconomic stability. National spotlights. Germany just approved natural gas drilling in a protected North Sea area, a controversial move designed to boost energy security after cutting off Russian supply. An agreement with the Netherlands will support the extraction of up to 13 billion cubic meters of gas. Meanwhile, Italy's finance minister Giancarlo Giorgetti says the country will stay on a fiscally prudent path. The deficit is expected to shrink to 3.3% of GDP this year, helping Italy secure lower borrowing costs even as it invests in defense and infrastructure. Over in Romania, the newly installed pro-EU government is taking aggressive steps to avoid a credit downgrade. It's preparing VAT increases, excise duty hikes, and a public sector wage freeze to bring the deficit below 6% of GDP. Poland, inflation fades, rates fall. One of the more surprising moves this week came from Poland's central bank. It cut interest rates by 25 basis points, bringing the benchmark down to 5%. Why now? Because the latest data shows inflation is finally cooling off. The central bank forecast shows consumer prices falling back within the target range in the coming months. That opens the door for further monetary easing, especially as economic momentum softens across the euro area. Oil, bonds, and the bigger picture. In commodities, U.S. crude settled at $65.11 a barrel, while Brent closed at $67.61. Energy prices are relatively stable right now, but the mood in oil markets is tense. Any sign of trade breakdowns, shipping disruptions, or military tensions could send prices sharply higher. Meanwhile, bond markets are signaling caution. The yield on U.S. 10-year Treasury notes fell 4.9 basis points to 4.234%. Reflecting strong demand for safe haven assets. Investors are still betting on a possible rate cut by year's end, but they're also hedging against risks from tariffs, inflation, and political instability. The non-farm payroll report isn't just another data point, it's a turning point. With July 4th falling on Friday, the report drops a day early. Analysts are zeroed in. If job numbers are strong, the Fed might hold off on rate cuts longer. But if hiring slows or wages disappoint, it could speed up easing. What to watch next? The headlines right now are dominated by tariffs, taxes, and the dollar's historic slump. But underneath all that, there's a bigger story unfolding. Markets are searching for direction in a rapidly shifting environment. Washington is using tariffs as leverage. Ottawa just reversed course on a major policy. Investors are chasing momentum in tech and crypto, and all of this is unfolding as central banks tread carefully through inflation and growth concerns. There are a few key dates to keep in mind. July 4th. U.S. markets close for Independence Day, limiting global liquidity. July 9th. Trump's tariff extension deadline for countries still negotiating. July 21st. Canada's new target date for a bilateral deal with the U.S. September 1st. Labor Day. Seen as a soft, final checkpoint for remaining trade deals. Between now and then, expect volatility, headlines, and more than a few political statements aimed at both domestic and global audiences. The dollar may be weakening, but the drama around it is stronger than ever. This isn't just about one currency's fall or a tax that got pulled. This is about how trade, technology, and politics are reshaping the financial landscape in real time, with power shifting, alliances evolving, and markets reacting every step of the way. The second half of the year is poised to be even more unpredictable than the first.